Yo, this kid Duncan asking me if I'm ready. Like it's my first. I don't know. I'm a little nervous. Mike, you ready?
I don't know.
Maybe you want a few minutes?
Let's go.
You don't have a few minutes. All right, listen.
I can't find my AirPods.
So what is that? Oh, you're back to the Kmart earphones? All right.
Kmart. These are Bose. Kmart.
Dude, nobody cares. I'm just kidding. I'm just teasing you. All right. It's what are your thoughts? We're going to play our favorite game. We're going to talk about the biggest topics in finance and on Wall Street. John is here. Duncan's here. I'm looking at the chat. I can see that the Duncan Hive is here. Put your bees up. Put your bees up for Duncan. He'll be back later with viewer topics. We got some great topics from you guys, by the way. We always get great topics from you guys. And if you want to participate in the show and tell us what to talk about, go ahead and send an email to askthecompoundshow@gmail.com. Okay, got nothing left. Let's get right into the show. Throw up that Y-Charts tile real quick. Y-Charts is the best sponsor in the world. We love Y-Charts. Tonight you will see several charts during the program. We create these charts using Y-Charts, and if you want to check them out, there's a link for a discount for first-time users just below this video, so feel free to do that. Okay, I wanted to start with the roaring labor market. I feel like we probably have talked about the strength of the labor market before, but really it is center stage right now. The jobs, the growth in jobs plus the wage growth both happening at the same time, and a lot of people coming off the sidelines finally. It feels really good to hear these stories and read these stories. What's your big takeaway from some of the labor market news that we've seen recently?
Well, I like that we're seeing some of the biggest earnings jump in the places that were hardest hit. So
wage gains.
What did I say? I'm sorry.
Earnings jump. No, I get what you said. Earnings by industry. This is a good chart. This is from our friend Sam Rowe.
So ones that were hardest hit, these people aren't just coming back. Like, they're coming back with purpose. So they're saying they're demanding increases in wages, and they're getting them. So for the first time, there's been a massive shift from labor to capital over the last 50 years, and it feels like for the first time in a long time, labor has the upper hand, and I'm definitely here for that.
They finally have the upper hand, and all of a sudden, it's like the worst thing that ever happened. We have to end this stimulus immediately. These people are actually dictating their own fate. They're like, you want me to come back to work? No problem. You have to pay me. You have to pay me, or I'm not coming. That's like something that we haven't seen in our economy for, I feel like, 20-something years. And I'm an employer. So I'm not like talking my book here. I totally agree with you. It's pretty cool to see leisure and hospitality up 15%, hourly earnings up 15%.
Retail up 9%. When's the last time these people caught a break?
Like literally never. All right, let's. This is some data from Axios from Sam. We love Sam Rowe. The June jobs report on Friday showed average hourly earnings were up 0.3% month over month in June. This continued growth is notable because it comes on top of 0.4% gain in May, 0.7% jump in April. So this is month after month after month. I know we're lapping a pretty disgusting economy from last spring, but there's momentum here. On an annualized basis, the past 3 months of gains represent a 5.9% pace of growth, which is substantially higher than the 2.4% average from the last economic cycle. So wages are rising by triple. Now, some of this is because we have a hike in the minimum wage, and some of this is just a scarcity of workers. Let me ask you this. Is this the story of inflation, like the good kind of inflation that we've always been told about? I feel like it is.
Of course it is. It's more. It's money in the hands of people that are most likely to spend all the money that they earn. So this is money that is going to be recycled, refiltered back into the economy. And throw that chart up one more time. So the pandemic was just threw a wrench in so many long-term charts. The funkiness of this is unbelievable. So you saw the spike in average hourly earnings in the early days of the pandemic, and I think this is primarily from lower wage earners dropping out of this data set.
Yeah, right. It's ridiculous.
So it spiked from that end, and then we're getting it from the other side, which is good. But I don't see how this is going to be bad for the economy. Listen, if prices overheat and we get spiraling inflation, then yeah, I'll change my mind. But until we have that, I think this is only a good thing that we're going to have more people spending more money.
Okay, two things. 850,000 new jobs for the month of June, which is amazing. And half of them were in leisure and hospitality. That makes sense. That's pretty intuitive. 151,000 people rejoined the labor force in June. So this is where the high wages pulls people back into the labor force that maybe otherwise would not be working. You're only going to see more of that when the federal unemployment runs out in September, no?
Yes.
This was interesting. 19.6% of the population is now in retirement. Maybe not permanent. Maybe some of these people come back too. But 2.9 million people chose to retire since the pandemic started, which is 1.7 million more than if it were at the same pace as 2019. So you had almost an extra 2 million people just decide, you know what, I'm done.
Well,
I'm finished working.
I forget where the data came from. Ben and I were talking about this today in the podcast. The Wall Street Journal reported that 55% of retirement was involuntary. In other words, their jobs went away and they couldn't get it. So there's it's a mixed bag as it always is.
Of course, nobody wants to be retired involuntarily. Everyone wants to be retired on their own terms, but I can't imagine that's most of this.
No, but it's so we're seeing is there a shortage of workers? I guess so. Yeah.
It depends on the industry. One of the biggest problems is it doesn't matter how long they keep interest rates at zero. Like Powell cannot wave a wand and make an out-of-work waitress become a Ford F-150 assembly line worker. Like that's not an interest rate story.
Yeah, I was about to say I don't even see how one has anything to do with the other.
Nothing. So that's going to be a function of time and people migrating geographically to where the jobs are and retraining, and that doesn't happen in 6 months, no matter what. So monetary policy is not going to help you with that. That is why we have 9 million job openings right now, and they're not being filled immediately. It's not that the market isn't efficient. It's that there aren't the right skills versus what the gigs are. But on balance, this is all good news.
I will say it's good. It's good. Yeah, and on balance, it's good. But where it's bad is there's a chart. I think the NFIB shows this chart showing the small businesses that are saying that they're having trouble filling roles. And for small to medium-sized businesses that don't have the deep pockets of corporate America that can afford a $15 minimum wage, it's really shitty for a lot of small to mid-sized businesses around the country.
Can I tell you something? Stay tuned on that because once again, the federal unemployment extraordinary benefit sunsets in a month and a half.
So this will probably
that is a big driver of why people are having trouble.
So this will probably work itself out. No, I agree with that. All right, let's move on to corporate earnings.
Okay, let's go. What are you showing us?
I want to talk about, so JP Morgan's Guide to the Market came out this week, and just one of the most beautiful charts that we see, and we talk a lot about our stocks in a bubble, valuation, whatever. And not always, but oftentimes we fail to think about the underlying thing that's going on here. What chart are we looking for? I'm looking for a chart 2-1, guys. So we're showing corporate profits and sources of total return. So these blue lines, again, these are projections. These are consensus analyst estimates, might or might not come true. But if you just zoom back, listen, why is the stock market go up over time? Because over time, empirically speaking, over time, earnings go up. Earnings have gone up. So that's on the left. And on the right side, we have the percent change in the S&P 500 year to date, and we've got the earnings growth of 19%. The S&P is up 14% year to date, and believe it or not, this is not coming from multiple expansion.
Yeah,
first time, long time. Multiples are contracting. We still got the gains, so that's kind of cool to see.
Let's explain that. Throw that back up. So basically, you have almost 20% earnings growth. What is this? This is year to date index to 100.
Yeah, exactly.
So I guess through the first 2 quarters, we're on pace for 20%, or we have year to date 19.7% earnings growth.
Right.
But in the meanwhile, the market's only up 14 and change.
Exactly.
Which means you've actually had multiples shrink in the market. And I don't think a lot of the bears are even aware of that. You know, they talk about 0% interest rates inflating stock multiples. Not this year, pal. Like that's not actually what's happening. You know what's cool about the earnings growth this year too? It's extremely broad based. It's not Apple, Amazon. It's all over the place.
So also in this chart, also in this guide, they show the top 10 stocks have an average PE of 30. Hold off on this chart for one sec. The average PE of the top 10 stocks is 30. The PE of all the other 490 stocks in the index is 19. Does that sound bubblicious given where interest rates are, given how the economy is booming? 19 times X the top 10. And bring that chart back to the forefront. I want to talk about this for a second. So we've got the top 10 stocks.
Michael, who are the top 10 besides the FANG names? Like, what are the other 5?
So Tesla, Berkshire.
Okay.
What are the other top 10?
I feel like there's a medical one, but
maybe Pfizer.
Yeah. Okay.
All right. Anywho, so look how the market works. So the top 10 stocks represent 29% of the total market cap of the S&P 500.
Okay.
And
which is a lot.
It's a lot.
We accept that.
Surprise, surprise. It's not. This is not hocus pocus. They also are driving 30% of the earnings.
Oh, we're J&J, Dylan Donegan, thank you. Visa, thank you, Part-Time Larry. We appreciate it. Roger Weatherford is correcting you. Bubblicious is not a word. I agree. It's a way of life, sir. I agree.
Exxon used to be a staple in the top 10.
Yeah, GE used to be in there. It's tough. Visa. I should have known Visa.
Berkshire's in there. I think we mentioned that.
But the point that you made, so pull out those top 10 stocks by market cap.
19 times. What are we complaining
19
about?
times. Listen, it's not a cheap stock market, but relative to the last 50 years, but relative to the last 20 years, it is.
And here's the other thing. Clorox is not in your face. I mean, that stock's gotten whacked. Home Depot is not in your face. You know what's in your face? AMC, GameStop, Tesla.
And these and AMC, GameStop have no market cap. Literally, who gives a shit? Apple goes up and down by $25 billion a day.
Right.
So as offensive, we're gonna talk about AMC in a little bit. So let's not.
Let's just go there. Go there.
We're going there now. New short seller in AMC. I've never heard of this firm. Have you?
The Federal Reserve. What are they doing?
Iceberg Cap Research. Apparently, the guy has a WordPress blog.
I'm more of a Romaine guy myself, but I'm.
Got me. All right. Let me set this up really quickly. So this guy's smart because he's now coming in after all the bullshit, right? And the stock hit 72. Now it's about 50. And he wrote something on his blog. He basically said, quote, "Our position is based on the fundamentals of the company and the fact its stock price has been inflated by call options, which is always temporary," said Iceberg's Arnold Wagner in an email to Reuters.
I don't want to be on the other side of that guy's trade, just based on his name alone.
Just based on his name, right?
Yeah.
He sounds like a badass, but he's like making such a simple observation, which is that, okay, you had a gamma squeeze. You had the market makers that were selling options to the Reddit crowd. They had to then go out and buy the stock to cover all those offset all those bets. Okay, we all understand that now. How long can that continue? That's like the interesting question. And he's just saying very nonchalantly, yeah, I get what happened already, but this can't last forever. Retail buyers can't keep a gamma squeeze going for 4 years. So now it seems like it's just a waiting game. What do you think about that?
Yeah, no, I don't disagree. But what if it happens again, like tomorrow? So look at. Do
you have enough call option buying as you did a month ago?
Pull up a chart.
I don't think you do.
Pull up a chart of GameStop, for example. There was a spike in January, the spike in March, the spike in June. So why get involved? I mean, I agree with the premise. You would think that this is gravity will kick in, but why bother?
So there's a guy covering AMC, one of the last people that didn't remove their coverage entirely. The sell side does not like covering these meme stocks. But the guy at MKM has a price target of $1. Who's being more unreasonable, the Bulls or the Bears?
I think this is easy. I think it's the Bears because they should know better. Like, in other words, they've been around the block and they've seen movies like these before, and they've seen how irrational markets could stay, and they know, they should know better. And what I mean by that is Bulls, yeah, there's obviously a ton of institutional big money in there that's piggybacking, but young people, hope springs eternal. These are young people that they're battling. So I feel like the Bears are being more unreasonable.
What if I told you I think AMC is a better short at 25 than at 50?
Okay.
What do you think about that?
Yeah, I agree. I mean, I would much rather short one of these stocks on the way down than on the way up.
Right. After people have been cut in half, that's when I think you have a much better chance of a short trade working out, even though you're doing it from a lower level.
Who do you think is being more irrational?
I think the Bulls are being perfectly rational. They know that $25 billion market cap is just not that much money. I mean, I hate saying that out loud. The Bulls don't think the fundamentals justify the price.
Yeah,
but
it's not relevant.
They don't care about that.
Right.
What they do know is if they can maintain enthusiasm for the stock, then there's no reason why they can't stay in the stock until the. By the way, the CEO, they were about to sell another 25 million shares or something. He checked himself, and he said because we respect the market sentiment. So in other words, he must have gotten wind from the message boards that the longs were pissed off that he was still diluting or something.
How about this? From a PR point of view, this iceberg person, I don't think it's a bad strategy because let's say, like, he could have a tiny portion of his book short this stock, and if it works out, it's great publicity. And if he gets carried away and it's a small position, who cares? Nobody will remember anyway.
It can't be a big position. I don't even think he's like. I could be totally wrong. But I think basically the blog is like he's like writing a blog, and maybe he personally has a short position. Like I don't know. I don't know that this is $1 billion hedge fund.
Okay, well, whatever. I like shooting your shot with something like this because the risk reward is pretty good from the short side, just from a PR point of view.
Yeah, I guess if I'm him and I'm shorting this thing from 50 or 52 or whatever, and it drops to 25, I'm not covering. Like at that point, I think the real carnage gets rolling. But
I love talking hypothetical short positions on other people's money. Yeah,
listen, I ain't doing that shit.
I'm covering at 23, not a penny higher. All right, let's talk about.
I have a mental short on right
So
now.
we've got something. So the past, I don't know if we did this last week or 2 weeks ago, maybe both. We're talking about the lack of participation, and how that might portend poorly for the bulls. That we've got record highs all over the place, less and less stocks participating. And then here we go. We had so since that talk, 7 days in a row, the S&P made a record high. First time that's happened since 1997. And so look at this. I mean, that's just one hell of a chart. 7 days in a row.
Family. Did you see fucking Amazon.com today?
Don't you family me.
Did you see this stock?
Yes, I did.
That breakout is ridiculous.
Holy Bazzoli. So
how is that not going to 4,000? I don't understand. How? Like how possibly? Who is selling that stock right now? I know that sounds very toppy, but this thing consolidated for 11 and a half months.
It felt like 5 years. I feel like every day we were talking about the stock, just stuck in the range. All right. So anyway, Sentiment Trader is back at it because the market hasn't changed. Listen to this. NASDAQ Composite says 1984. There's been 1,080 new highs. Let's call it 1,000 new highs since 1984.
1,080 days where the stock market made a new high since when?
1984.
Okay. That sounds right.
On those days, an average of 50% of stocks on the NASDAQ advanced on that day. Today, meaning today, only 31% of stocks on the exchange advanced. That's the lowest ever.
At a new high?
Yes.
Only so 2/3 of stocks were red and we still went up?
More than that, yes.
Okay. Apple and Amazon are like 12% of the S&P. Google's $1 trillion. Microsoft is $2 trillion. Like these are, I hate saying this, but this is really all you need.
Well, listen, it's been all you need. I'm not disagreeing. So I just want to talk about one other thing. There was a big jump in bulls last week. AAII does this survey that they've been doing forever. And I think I haven't really tested the data. I know Nick did and a bunch of other people have ripped this apart to see if there's any signal here. And just like eyeballing it, let's look at the bulls. So these bull spikes, I know you can't really see it here. I'll throw this chart up on my blog data.
They fade, but the market doesn't.
Pretty much. Pretty much.
Like, what other takeaway could you have from this?
Pretty much. There's very little signal here. Yes, people were bullish in October 2007. Of course they were. But the bull spikes that you've seen don't really, there's not really much there in this way of timing. But if you look at the bears and the bear spikes, again, I'll throw this chart up because you can't really see, but all the bear spikes occur at market bottoms. Now, I'm not saying that you could time this in real time because you don't know when the bear. It's
intuitive, though. It should be that way.
Of course it is. You can't. But so if there's like one iron law in finance, it's that people will be bearish at the bottom. But we pay so much attention to bullish enthusiasm.
But with good reason.
Of course. Yeah. Go ahead.
The bear spikes don't occur out of nowhere like a rainstorm in Miami. Like there's something going on. That I just went back and looked at the VIX chart. From the last, by the way, if you want to laugh,
87.
from the last 3 years.
Oh yeah.
The VIX spike on March 14th.
Ridiculous.
The VIX was 83.
Okay.
Could you imagine getting long vol at an 83 VIX? Do you know nothing about the stock market at all? Or in that moment, do you genuinely think it's the end of Earth?
I don't think.
Like, what makes somebody pull the buy trigger
I
on a
don't-
vol trade at
I don't-
VIX 84?
I don't necessarily think that it was people buying VIX products at the peak of the VIX. I think it's measuring implied volatility. It's measuring how expensive options are. So
I understand that, but there are people that are very. You saw a bear spike in your chart. That's got to coincide with people expecting more vol
every time.
every time.
Yeah.
All right. The most bearish thing you can say.
Well, listen,
anytime
hand up. I'm bearish at bottoms. Who isn't?
I almost feel like it's okay to be bearish at bottoms. It's better than being bearish at tops. Because you don't know it's because you don't know it's the top. You always think it's the top. I think that's almost worse.
Yeah.
All right. Are we done here?
I'm good.
Okay. Congratulations on the quarter, gentlemen. Record highs to start the third quarter.
Speaking of quarter, download Quarter app. It's the best earnings app.
People don't know what it is. Tell people what it is really
It's on the
quickly.
screen. QUARTR. It's all you need for like earnings conference calls. You could download the PDF right in the app. You could listen. You could forward to the Q&A. It's a great app.
I listened to 2 or 3 shows on that app, and then I forgot I had it on my phone. I'm gonna go back to it. I'll be ready for Q3 earnings. Okay. Q2 earnings. Barron's put Buy Europe on the cover again. They do this once a year. It's always wrong. Nobody ever makes money from this call. I said I said this morning, they can't help themselves. Most of these guys or gals that write these articles, they're great journalists. They're good writers.
What year is this from? What year is this from?
This is 20. All right, wait. Slow down, John. Slow down. This one with them linking arms is 2012. It's immediately following the worst year for Europe since the Black Plague. The continent, they were fucked up. The continent almost like broke apart, and they were having all these elections where like neo-Nazis were winning. It was like just an ugly time, and somehow they shook it off. But the whole EU almost broke up. So they said Buy Europe. What's the other one with the planet Earth on it?
Yeah, Buy Europe.
Okay.
What year was this?
2017, also wrong. And there are more. It's never right. And the reason why it's never, first of all, the reason why they keep doing this, Europe is always trading at a discount to U.S. stocks.
To what?
And the editors of these magazines, not just Barron's, all have read a lot of Buffett and Howard Marks, and they're steeped in this idea of buying assets when other people don't like them. The problem is nobody will ever like European assets because they have a cultural deficiency with respect to running full tilt capitalism the way we are here, and those stocks will never trade at a premium to the U.S. unless something really messed up is going on, like we get invaded by Canada. Like why would Europe A, trade on a par with U.S. valuations, and B, why would it outperform? So I'm not even asking you rhetorically.
No,
when did it outperform?
Well, all right. First of all, let's go to. You're right.
I love Europe. Like we're talking about the stocks.
Let's go to chart 5-9. So from 1970 all the way to 2014, Josh, they performed neck and neck. Are you telling me that the cultural whatever you're saying changed in the last 5 years?
Yeah, I think it's been exacerbated by Silicon Valley taking over the S&P 500. They don't have an equivalent. There are many great high-tech companies in Germany. I know UK is not in that index.
The DAX is looking juicy, by the way. Pull up a chart of the DAX.
Well, this is a cyclical chart.
So there we go.
Automakers and banks.
So go to chart 5-4. So this is showing the representation of cyclical and technology centers by region. And take a look at Europe. Only 8% technology, and that's pretty much all you need to know. S&P is 27%. But cyclicals, Europe's got 54%. And chart off.
Please.
And cyclicals are most correlated with a strong or weak economy, and they're calling for 6% GDP growth in Europe. So if the cyclical trade comes back, then they will outperform. But if it doesn't, then they won't.
I think investors should have exposure to Europe. I don't think investors should have exposure to Europe because it's going to outperform the U.S. It ain't going to happen in a bull market, and in a bear market. Where's my chart? Chart on. This is from Barron's this
5'8",
weekend.
5'8".
Thanks, Mike.
I feel like Fred Norris.
So look, the blue line is Europe, the black line is US, the floor is lava. You got destroyed into a million pieces during the coronavirus panic with European stocks, just like you did here. In fact, worse, because it started from a lower level because you barely made any money there. And look at the recovery. Europe is like not even back to 2019, late 2019 highs. The U.S. is materially higher than
argument.
2019
Listen,
already.
no argument.
So what is the point?
Well, here's the thing. One of the reasons why their market has done so poorly the last decade, or their markets, I should say, is because their economies haven't done well because they've had a lack of fiscal integration. They've been a mess all over the place. And yes. I think that is starting to change how they're responding fiscally. So Barron's wrote, or this is from, I'm not going to try and pronounce this person's name, I'm sorry. The CIO at Centerstone Investors said, it took a sovereign debt crisis, Brexit, and a pandemic to bring European leaders to an agreement on a jointly financed economic stimulus. That was from Barron's. This person said the post-financial crisis period highlighted the glaring weakness of having a common currency and economic union without a real fiscal union. Fiscal integration has been the missing piece, and now it's here.
Well,
I said it's now here.
So now they're issuing. The northern countries calmed down, and now they're issuing bonds to help support the countries that were hit by a lack of tourism
Greece,
in the south,
Italy.
like Spain, Italy, Greece. And that is the first time that the Eurozone is issuing bonds as though they're the U.S. Treasury. And that I agree.
That's a big deal.
I think it's a big deal. I agree with that because what it could lead to. Ultimately, they're gonna need something that's closer to what we have going on. I don't know if culturally. But then I think twice, and I'm like, all right, I get it. The Netherlands are nothing like the Italians, right? I understand that. But how much am I like people from Texas? Not much. So maybe they can do more fiscal integration, more fiscal stimulus, more monetary stimulus, or less monetary stimulus, more fiscal. Maybe that's the right answer. I still don't think they have enough hot consumer discretionary and tech companies. I know LVMH has been a monster home run there. Congratulations. They need like 50 of those, and they just don't have them. All right, we can keep moving.
All right, I want to get your opinion on this. So you can get lucky in the stock market. A lot of people do. It's hard, but you can. Can you get lucky building a business? And I don't mean like a 6-month stretch. Like, can you sell a business and just be in the right place at the right time and not be able to translate that success into another business?
Did you read this article in the New York Times about the two breakout superstars of the PPP loans? Did you read that?
I did not.
There were two apps. One of them is called Blue Acorn and one of them is called Wampy. And when I finished reading this article, I wanted to punch myself in my back.
Right.
But my arm doesn't reach. I wanted to give myself literally like a punch in the spine. These two firms, neither one of them was in the business of making consumer loans at all. One of them, the company didn't even exist, and the other one, the company did something different. I forget which is which, but Blue Acorn and Wampy together were the two biggest issuers of PPP loans, bigger than any of the banks you've actually heard of. How did they do it? They bought Google keywords and drove traffic to their app, and they were serving customers that were unbanked or had no relationship at their bank. Like,
but
literally.
Wait a minute. But that sounds very, very intelligent. Good business savvy. How is that luck?
Because they were just in the right place at the right. Well, let me finish this. Let me finish my point. They made like $6 billion in fees in 1 year. All of those fees are paid by the government. Like, they literally got the government to give them $6 billion. These businesses didn't even exist prior to the pandemic. So to me, it's not that they weren't smart. Everybody's smart. They were really lucky that the banks weren't ready to make loans to Uber drivers and hairdressers, and they were. And they killed it. And actually, I know of somebody, I don't know the person, I heard the story, somebody that made so much money, like tens of millions of dollars, that they're literally having a goodbye party from New Jersey and moving to Florida because the thought of paying that much back in taxes on income like that for 1 year is that unthinkable.
So okay, good examples. I guess my knee-jerk reaction, I haven't thought deeply about this, is that it's much easier to get luckier in the stock market than an actual business.
In a year like last year, yes. In
Generally speaking, I think more people get lucky in the stock market than they do in business.
The story I just told, I think, is very unique. I would agree with you. You're probably not going to have stories like that all the time. And when the government is doing some huge, crazy thing, whether it's ramping up for a war or doing whatever we did last year, somebody's going to be in the right place at the right time. But I agree with you. I don't think that happens often. I think often people just buy a stock on a tip, and it like works out beautifully. Not always, but like that is probably easier than accidentally succeeding
exactly.
in business.
You're not going to fall into a good business.
Yeah, I think that's fair. Okay, where's my boy? Duncan Hive, activate. There he is.
Hey, guys.
What's happening, Duncan?
Not much. We got some good questions. Oh, Josh, by the way, did you watch any more F1 this weekend by any chance?
No, I hung out with babes instead. Okay. Honestly, this weekend I was the biggest D-bag I have ever met. I couldn't even look at myself in the mirror.
Enough. Right, we don't need to go into details.
I spent the entire weekend drinking vodka on a jet ski. I hate myself.
I thought you were a tequila person.
I know. I don't even know what's going on. The whole thing is just
Do we have insurance? Do we have insurance on you?
Maybe my kids need to come home. This is too much. All right, go ahead.
Okay, so first up, we have a question from Andrew, who writes, do you think the drop in price for some SPACs or recent de-SPACs has given retail investors a unique opportunity to act like VCs? For example, companies like, and I haven't heard of some of these, but Alight, Payoneer, Apex, these companies are actually growing, profitable companies, but have all dropped below $10 a share as part of group punishment for SPAC mania. Seems like there's some really good companies falling through the cracks. What are your thoughts?
Mike, what do you think? Are you sifting through any of these?
I'm combing the desert.
I think it's too tough to speak about SPACs in this monolithic of a fashion. The research actually suggests that the best time to own a SPAC is between the time that they announce the deal and when there's actually a vote on the deal. And then the best thing you could do is get out, and probably you'll get a chance to buy back in sometime after the deal closes.
Honestly, I don't like the idea of trying to find the value SPAC. Like, I don't think that's smart. No.
So it looks like after 8 weeks from the de-SPAC, so in other words, the SPAC changes its ticker and its name. After 8 weeks, that's when these things on average start to trade on their own fundamentals. And in that time frame, that 8-week period, there's about 50% turnover in the shareholder base. So in other words, it's not a great situation until enough time has gone by after the de-SPAC. So I have my eye on a couple of them, not because they're SPACs, but because I'm interested in the companies. But I would not spend a lot of time on that project.
You stalking these names, you son of a bitch?
I'm stalking this one, GHVI, Gores, which is about to de-SPAC into a company called Matterport, which is like the Google of
pastrami.
Like four-dimensional real estate. Like they have millions of buildings in their database, so that realtors can see them, construction people can see them. They're like the biggest company that does that. But this thing has not been acting well, and I think I'm going to wait till after it de-SPACs. So, somebody's saying SoFi. SoFi's looking better. Did you look at this chart recently?
This is one of Chamath's. Is that right?
This does not look good.
No. I would say that this is.
I mean,
like,
listen. This thing's been public for like a minute. I mean.
Yeah, I don't know when it de-SPACed officially. It still looks shitty. All right, let's move along. What else we have?
Okay, so up next, we have a cool question from a 17-year-old investor who watches us. So Bennett wrote in from Nashville and said, "I'm a big fan of Compound. I have a portfolio of 25 stocks, including they've listed quite a few, but CrowdStrike, Uber, PayPal, SoFi, and other tech stocks. I also have some money in crypto, primarily Ethereum, after reading Own the Internet by Packy McCormick. My question is about diversification. Since you diversify to keep your money and concentrate to make money, how should I concentrate since I have time on my side? I own almost all growth stocks, and I'm not sure what the best path is. Should I own fewer in an effort to earn a higher return? And so part of this that I mentioned to you, Michael, I thought was interesting is how they specifically mentioned crypto. And so I'm just curious, how that plays into this as well.
Yeah, I'll start with the stock part of it. The best stocks for the last 1, 3, 5 years have been stocks that are growing the fastest. But it's not always that way. In fact, empirically, if you want to hear somebody smarter than me talking about this, Toby Carlisle was on Corey Hofstein's podcast talking about flirting with models, talking about how the stocks that have the highest earnings growth don't have the best performance because the
valuation is too high.
The expectations just become you can't reach them, right? Like triple digit earnings growth is not sustainable. And so even though it's worked really, really well for the past few years earning these growth stocks, that's not always the case. And so I would just say, obviously I'm being sarcastic, to concentrate on the best names. And unfortunately, you don't know that ahead of time. If you did, you would only need to own one stock, but you don't know which is going to be the winner, which is going to be the losers. And I think that you almost have to earn the right to have a concentrated portfolio. And we have these legends like Stanley Druckenmiller talking about diversification. Why would you own your 10th best idea? No offense, you don't know what your best idea is. You'll know after which is the best performer, but you won't know ahead of time which is your best idea.
So this is how you know this. This is like the real shit. Like, we keep it real. I totally disagree with Mike on this. I would say if you're 17 years old, you should not be buying companies that make metal cans. Even if you're giving up something in performance, it's a waste of your time and energy even learning about those companies. In the end, they're either going away or they're going to sell at 6 times earnings forever, and there's just better things for you to spend your life on. So what I would actually say is you should own the index. And I'm talking my book. This is how I invest. You own the whole market. You'll own the slow growers at the good valuations with dividends, and you'll own the Amazons, the CrowdStrikes, the whatever. And then on an individual basis, you should own stocks individually that you're actually excited about and interested to learn about. And that's the time that you should spend on the Quarter app and listen to a conference call for Moderna. Listen to a conference call for Intellia or Editas or the companies doing CRISPR shit and gene therapy. That is what a 17-year-old should do. I don't think you should be building a portfolio of fucking breakfast cereal stocks. It's a total, I don't know, just my personal opinion.
Hold on. I agree with everything you just said, but I disagree with you disagreeing with me.
Chart off.
What am I talking about? Breakfast stocks and materials. What are you talking about? I'm not saying...
Well, you're not saying only, but you're saying there are certain market environments where the slow growers are the better performers, and I agree with you. I'm just saying it doesn't matter.
You're putting words in my stream. I just said that owning the highest growth stocks is not always the best strategy.
Oh, I agree.
Yeah.
And then my second part of that is, so what? It's the best strategy if you're 17 and you're looking to learn how the market works. You're going to learn more, but I think, by studying growth companies, even if you get blown up in a few.
I also do. I think you made a good point. I think at a young age, you're probably better off investing in 5 stocks because then you could actually learn. I think if you invest in 20, it's it's really hard to do it that way.
All right, so maybe you and I are on the same page after all. You see, guys, we really tied everything together in just 30 minutes. It's like a sitcom. Michael got down on one knee, like Danny Tanner, and he walked me through it, and I had it wrong, and I think we're on the same page.
Danny Tanner. Oh, like you're my Michelle. You're my baby.
I am Michelle. All right. I think that's it for viewer topics. Are we doing anything else, Duncan?
No, I think that's it.
All right. Duncan's going to get back to planning his wedding. We are going to.
What are you guys doing tonight?
Finals.
Me too.
Bucks Suns, 9 o'clock. I'll come over. We're going to say goodbye to everybody. Thank you guys for watching the live stream. You know we love you. Please go ahead and favorite the video if you haven't already. If you're not a subscriber, like I don't even know what to tell you at this point. How could you not be a subscriber? Go ahead and click the subscribe button. Click the bell for alerts, of course. And we will see you guys next Tuesday at 5:30.
Adios.